So I think I'm live. We are live. Excellent.
We are live indeed.
Thank you, Lena. Good afternoon, everyone, and welcome to. And I think I'm sharing screens. I'm doing quite a lot today, so no heckling if my administrative or management skills go a little bit awry. Good afternoon. Thank you very much for joining our virtual 20s Revival Forum, which is quite a name. Let me explain what it is before we get going. So I won't introduce Office Power, although Office Power is kind of hosting this event because hopefully you know what Office Power is. But if you don't, then I don't want to kind of waste your time. However, what we do with Office Power is want to meet as many people as possible so we can learn about the sector, learn about the changes, and you know, I understand we're going to meet potential partners. I can hear my echo. Thank you. And so we have always put on events, and particularly during the pandemic, actually, we produced a lot of content and put on events, and we've always opened it up since the pandemic or since the first lockdown, if you want to go back that far, to a wider audience. We were very brave, some would say foolish, to hold an event, I think it was in July, an actual physical event in July, just at the height of the pandemic. But we managed to persuade, cajole, and bribe 30 or 35, I think, people to join us in what was actually an excellent event in Birmingham. Thoroughly enjoyable to see people after such a long time. And a lot of people that we spoke to wanted to come but couldn't come, partly because they were worried about the pandemic, partly because they had COVID, partly because everyone is super busy. So we committed at that time to put on a virtual a Revival Forum, and that is my very long introduction as to why we are here. Next slide, where I do that. So what are we going to talk about today? Well, you can. It's a virtual event. I would encourage you to stay for the majority if you can, particularly I don't want to put you off the first sessions, but particularly the latter two sessions. But we're going to start with Nick, our CFO. If you don't know him, you shall meet him shortly. He's very good at making the seemingly complicated world of economic trends a bit more simple, and he's going to spend half an hour taking us through some data that's in the public domain, but his interpretation on it, really trend analysis. Then Rich, our COO, who looks after our technology and products teams, is going to talk about what we think that will mean for the technology requirements, given the economic and a little bit of social. We haven't got time to talk about all the social changes, and we've deprioritized that, but that is available online if you want to see it from the first event. So we'll talk about technology a tiny bit. Then I'm delighted, and I'll introduce them and they can introduce themselves at the time, but I'm delighted to have persuaded 4 industry leaders to join us in a panel debate. You will note that Adrian Butler has morphed into Nicky Todd. Adrian very sadly has, well, I'm sure he's fine, but he has, we think for the second time actually, contracted COVID yesterday or this morning. So we wish him very well. But Nicky's very kindly agreed to step in and look at it from a wholesale perspective, as could Stuart. But we'll talk about that more later. And then at 3:15, we'll have a quick comfort break. We'll try and squeeze one in, rather than squeeze one out between that session and the strategic planning session. And that is amazing. Chris is amazing. So just definitely hold on to that session. And get your planning conundrums ready. He will talk about the different stress testing techniques that he's used in the military when planning is so critical. And we're going to open the floor actually, and you can ask him questions about your planning conundrums. And I know you'll have lots of them. So hopefully you can be brave enough to share them in chat or share them openly by taking your mic off. Cameras are amazing, but not compulsory. It just makes us all feel that everyone is engaged. But of course, if you want to turn them off, feel free to turn them off at any time. There aren't, I don't think, any house rules apart from there is Alina Fisher somewhere on your screen, who is very bright in orange, who is our group marketing director.
I am here indeed. Yes. Hi everyone.
Excellent. So Alina will keep us on track. She will probably interrupt when we're doing something wrong. If you have any questions or problems, then either put them in chat or just privately message her, and she'll sort it out. So that's the gist. We are recording this. However, I think everyone should feel free to say what they want. So say what you want. We won't release it until everyone has kind of had a day to reflect on what they've said, if they say anything. We won't release the chat script, to be clear. And if you have changed your mind on anything you've said, or you don't want it to be released on the video, then we'll just edit it out. So please feel free to say whatever you want, whenever you want, as long as it's relatively relevant, is probably the only criteria. Okay, enough waffle from me. Let's get going. So somewhere Nick is around. There's Nick. I'm
here.
Excellent, Nick. I'm just gonna read your mind and try and flick the slides at your pace. If they start flicking quicker, that's normally an indication you need to hurry up.
Fair enough. I'll try to go at the correct pace.
Okay, great.
Great. Okay. Well, good afternoon, everybody, and thank you for attending. And like Simon said, I also wish Adrian a speedy recovery. So I've got quite a bit of data to cover. I'm going to look at the impact of COVID on the overall UK economy, and also look at some of the forecasts that people are anticipating, all the economic indicators we've got and where people are expecting those to trend over the next 6, 12, 18 months or so. This is a very macro economic view. So, all of our businesses are affected one way or another by a lot of these macroeconomic indicators. But clearly some of them have a much greater impact on us than the others. But bear that in mind. We are looking at a sort of helicopter view of the overall UK economy. Okay, so if we move on to the first slide. So here we have the chart on the right-hand side here is basically a view of the overall UK economy from a GDP growth perspective. And GDP tends to be used as the sort of main primary indicator of the economy's performance. Incredibly well documented. Everybody knows, obviously, 2020 was a horrific year with very nearly a 10% overall decline in GDP. At its peak during the first lockdown, GDP was running just over 20% down. So, it's unprecedented in nearly 300 years of GDP measurements. However, business consumer confidence reached a 5-year peak during the last quarter, towards the back end of the last quarter. It is starting to dwindle again now, but overall, most people are relatively positive about the overall expectations for the economy over the next couple of years. And in general, we're expecting a recovery of around about 6 to 7% in 2021. And around about 5 to 6% during 2022. So, we are looking to recover, and there are a few risks to that recovery that I'll come on to later. And the key drivers of that recovery are going to be consumer demand, business investment, and general government consumption, particularly during 2021, where government consumption has materially increased. So if we jump on to the next slide and specifically focus on consumer consumption, household consumption, why? Typically following an incredible recession, which we saw during 2020, typically household consumption is very slow to recover. But what happened during the lockdown period is, as you can see from the chart there, typically households are saving around about £5 billion a month or so. That's an average savings rate across the economy. However, we saw a switch of spend from normally the majority of spend sits in service consumption, and then there's goods consumption also on top of it. And we saw a massive swing basically where service consumption dropped by 120 billion throughout 2020, which was linked to things like hospitality, travel, cinemas, all of those kind of typical services that we're consuming on a day-to-day basis that were closed throughout all the lockdown period. And only 8% of that decline switched into the consumption of goods. So the rest of it could have been as a result of drops in income, but the reality is as a result of the furlough scheme, disposable incomes largely stayed flat, and as a result, we saw a huge increase in household savings. And it's estimated around about somewhere between about over this period, we hit an average saving of about 16%, which dropped from a peak in the first lockdown of about 26% of total income being saved. So what are households expected to do with that? Well, as we're now just starting to see, and over the last few months, they're expected to spend, and that is driving an incredible increase in demand for goods, in consumption across all sectors of the economy, which is speeding up the overall recovery. So that is a very, very different situation to previous downturns in the economy, where it's taken a lot longer to recover, and it's a key driver of that kind of V-shaped bounce back. So if we move on to the next slide, please, Simon. I talked, like there are some downside risks. Where are these coming from? Well, obviously, further restrictions hitting the economy. However, as we saw in the last lockdown at the beginning of this year, most businesses have now learned to adapt to it, and clearly it has an impact on the performance of the economy, but not nearly as severe as an impact as we saw during the first lockdown. But if we do see some tightening of restrictions over the winter, then that would obviously impact all of our businesses and the economy as a whole. Secondly, a key risk that faces all of us who have a roster of customers, insolvencies, business insolvencies. So typically, business insolvencies run at around about 4,000 companies per quarter. That is a typical business churn. There are constantly businesses going out of business and new businesses being created. And as you can see again from the chart there, that increased significantly following the financial crisis in 2008, and peaked up at around close to the 6,000 businesses a quarter. However, we've actually seen a weird thing going on over the last 18 months, where we've seen a decline, and that's because of the restrictions that the government put. The courts have been shut to winding up applications, and as of the end of September, that started to open up again, and there is a lot of kind of pent-up demand for court proceedings. And it's generally anticipated that we're going to see quite a bounce back in the number of insolvencies over the next kind of 6 to 12 months. And clearly for everybody, that faces credit risk for all of us on our ledgers. And tight credit management is going to be absolutely critical over the foreseeable future. Finally, another key risk is inflation, or worse still, stagflation. Which stagflation is essentially an environment where you have inflation, and inflation is normally sits alongside economic growth, but stagflation is where you have inflation while the economy is actually declining. Now, as I said earlier, we're expecting growth, but there are a few risks to that, and if we do start to see some of the growth reverse, then inflation could turn into stagflation, which for any of the older viewers out there, was what we saw in the 1970s and presents huge risks to an overall economy. So I'll come on to inflation because it's key and it's very much in the news at the moment, and I'll come on to that a little bit later. Now focusing in on the impact of COVID on different sectors of the economy. Overall it has been uneven. Different areas of the economy have definitely suffered more than others. So starting on the left-hand side of this slide, with the manufacturing and construction sectors, these were probably the hardest hit sectors during the first lockdown. However, they also bounced back at the quickest rate, and they were hardest hit because they were closed down completely. Construction ceased, and manufacturing largely ceased as well, because workers were not allowed into factories, as opposed to the service industry where people could work from home and continue. So, but the bounce back and the recovery, as you can see from the chart there, was extremely quick. And the construction industry, by the end of the first quarter of this year, had largely recovered and has continued that recovery over the last few months as well. Manufacturing very close to recovery and continuing improvements. Then looking at retail and other personal services. So other personal services would come back to some of the things I talked about earlier: gyms, hairdressers, etc. Retail has actually been largely unaffected. We did see a bit of a drop during the first lockdown, but actually that sector has grown and is now larger than it was pre-pandemic already. So as a sector, retail has been the main area that has actually thrived through the last 18 months, whereas other personal services, as you can see there, the performance of those sectors has fallen very much aligned with the lockdowns. So as people have been forced home, not able to mix, etc., you saw those sectors hit hard. But then as soon as we came out of those, you've seen a recovery, and already most of those personal service sectors now are back to pre-pandemic levels.
Nick, just a point of clarity on retail,
Go for it.
because people might be thinking about the high street and how that has suffered. These retail numbers include online, don't they?
Absolutely, yeah, and I think Rich may come on to it, but a significant volume of spend has moved into online, and anyone with online customers will know that those businesses have thrived, largely over the last 12 to 18 months, and this is talking about retail consumption, particularly, not business consumption.
And another point of clarity: there's a lot of data here. We will release these slides afterwards, so don't feel you have to read everything. Better to listen than to read, I think.
Excellent. And then looking at regional recovery as well. Again, a very different profile to the normal recovery that the UK experiences after a recession period. This time around, the southeast, London, and the Midlands, predominantly focused around Birmingham, have been the slowest areas to recover. As you can see there, the dark blue line represents the 2020 Q2 kind of decline, so during the first lockdown, and the impact on the GDP of those areas during that period. And the lighter blue line represents the most recent quarter, the quarter in 2020 Q3 recovery. And as you can see there, those that have been the slowest to recover are the areas that normally you would expect to bounce back the fastest. But as we talked about, as I just talked about earlier, the service industries are the ones that have been hit hardest, and the service industries tend to be focused in those large urban conurbations and also particularly in the southeast of the UK. So it's a very different type of recovery that we're seeing at the moment. And This plays directly into the government's levelling up agenda, whether you believe it or not. But the government, have part of their manifesto was very much based on intending to try and drive an overall levelling up across the UK. And the first thing that they announced in the March budget to try and help drive this as well was the introduction of 8 free ports, which were largely concentrated, not exclusively, but largely concentrated around the north of the UK. And those free ports are designed to drive inward investment and to grow the economy in those areas. The exclusively focusing on just pure economic indicators, though, will not be the only thing that's required to clearly drive that levelling up agenda. Healthcare and education, etc., are clearly other areas that the government will be trying to focus on as soon as they can, I would imagine. Moving on, so I talked earlier a little bit about some of the labour market, and we talked specifically about disposable incomes that remained largely unaffected. And why is this? Ultimately, it's the furlough scheme, the coronavirus job retention scheme, as it's unglamorously called, which, again, a lot of us have talked about whether it's gone on too long or, etc. But it has been a resounding success. It has absolutely been a critical part of the government's strategy to keep the economy going. At its peak, during the first lockdown, nearly a third of all private sector employees were basically being paid for by the government. Which is, quite extraordinary a statistic if you roll the clock back a couple of years. Earlier this year, clearly, we saw a very much a slowing down. Then, as and when we saw pickups in lockdowns, etc., we saw people going on and off furlough. As we entered the summer and were just coming out of the final lockdown, there were still nearly 3 million people on that scheme. And there's been a lot of talk about what might be the impact of that at the end of September. It really is too early to say. We're only a couple of weeks into October. And but we haven't necessarily seen the wave of potential redundancies that everybody was talking about and anticipating in the start of the summer. There was a pickup, some increase in redundancy applications during sort of August and September time, but nothing like the overall expectation. And most people are expecting roughly 90% of people that were on the furlough scheme towards the end to return to full-time employment. And if that does turn out to be the case, then unemployment will peak at about 5 to 6%. Next slide, please.
Yeah, I've just got a question actually, okay. Or just a thought, and please feel free to post comments in the chat or just thoughts. 2 things that come to mind. One is how unusual the circumstances are. I'm not using the unprecedented word, but how unusual it is in terms of the shape of the labour market, the loss of labour as a result of Brexit. But the other bit that I'm unaware of, but the increase in public spending to try and support to support the country through the pandemic. Do you have it, Nick? I'm putting you on the spot. Do you have any data on the number of people employed in the public sector? And whether, because I'm just thinking all this government spending, yes, a lot of it is on loan support and support schemes, but there's also a lot of schemes, supporting, the pandemic, etc. I'm just thinking about the volume spent in track and trace, and obviously a lot of that went on technology that is dubious, but a lot of it goes on people calling you. Be quite interesting to see the swell in public sector employment, and I'm not sure if you know anything on that or for anyone else.
I don't have specific information on that, but if you remember the opening slide, a key driver of GDP growth in 2021 is actually government spending. And that is on areas like track and trace, where the government have invested, phenomenal amounts of money. And I know, for anyone who's had caught COVID or whatever, you will be on the receiving end of hourly phone calls and people checking and coming around and knocking on your door or so. So the government is investing a huge amount of money in that area, and on the NHS in general. So there has been a significant increase in spend in that area. To a slightly lesser extent, education, spend on education has increased to try and catch up from some of the missed, education over the last 18 months or so, but not quite as much as in the health sector.
Thank you.
Inflation. This is very much in the news at the moment, and I think we're all feeling it. Every single sector of the economy is feeling it at the moment, and there are a number of factors sitting behind inflation, and there are some fairly scary numbers being thrown around as to where inflation may peak. The chart on the right-hand side here was prepared 2 or 3 months ago, and in the last 2 or 3 months, it's been revised. And some commentators are now expecting inflation to possibly peak out at about just under 3% or so in 2022. To put it in perspective, obviously the Bank of England's target is 2%. So we're talking, we're running significantly higher than that. But there are some, some obvious explanations for this, and there's also a general overall view that this will come back down relatively quickly. There are some risks to that view, as I said earlier, but the overall view is it will come down relatively quickly.
I've got another question on this actually. This is my ignorance. Stagflation. Yeah.
Yes.
Can you have stagflation at a micro level? So I'm just thinking. I know you're
at a micro.
Yeah. So I know we're at a macro economic level at the moment. But if you think about our industry specifically, where we haven't got growth. In fact, we've got underlying decline. But we've got already, but a lot around the corner. We've got significant inflation coming. Definitely the turn of the year. What happens? What happens? Why is stagflation so bad? What happens when there's stagflation? I assume that interest rates go through the roof. But also, what happens? Can it occur at a micro level, like in a specific industry sector? And if so, what are the ramifications? This is my ignorance. Sorry.
Yeah, no. I think it's a great question. And I think the answer to the question, I don't know, but I think the answer to the question would be absolutely. And I think our industry would be a very, very good example of an industry that is facing those kind of headwinds at the moment. We are seeing significant inflation, both in terms of cost prices, as are most industries. We're also seeing significant wage pressure, as everybody is seeing across most industries at the moment. But the flip side is that we're not seeing the increases in demand, whereas many other sectors, if you look at the retail sector, etc., they are seeing the increase in demand, and as a result, the higher demand levels mean that essentially they tend to balance out those pressures on that are coming from inflation. Whereas we essentially as an industry probably are in that sort of stagflation environment, and the real problem with it is at best, the stag element of the phrase comes from the fact that we're stagnant, at best. At worst, you find yourself in very much a downward spiral that's very hard to pull out of. And that was where, when the whole economy gets into that, you end up the government's reaction to it at a macroeconomic level is then to pile more cash into the economy generally, to sink more investment in to drive growth, but then that has the effect of driving inflation up, and so you end up in that downward spiral basically that is very, very difficult to pull out of. So yeah, we as an industry may well be in that kind of sinkhole at the moment, and how we face that risk will be an interesting one.
Thank you.
But quite depressing. Key drivers of inflation at the moment, well, energy prices. All of us have been affected. We've probably all sat in queues to try and get fuel into our cars, trucks, etc. over the last month or so. Well publicized gas price increases, and what basically happened during 2020 was that the demand for energy massively dropped. Therefore, reserves, the price of fuel, etc., dropped considerably. The reserves were all consumed, and most countries found themselves in a position where, as producers of energy, those countries that produce energy were not producing it because the demand wasn't there, whereas the consumers of energy just sapped up their reserves. And we're now in a situation where we as a country have very little reserves left, and we're trying to get our hands around the reserves that are out there, but so is everybody else. So there are limited reserves and huge amounts of demand for it, and that is pushing up cost of transport. It's pushing up costs of any industry that has a high energy consumption, and it really is it is impacting all of us, and that is driving up price of end manufactured goods. It's driving up household costs, etc. So energy is definitely a key driver of inflation at the moment. Next slide, please.
I'm stuck. Hold on.
Oh no.
No.
Here we go.
Apologies.
So then another area driving up prices is just general supply chain shortages, and higher commodity price, input prices into that manufacturing process. So once again, we're all feeling it. We're being told it by the wholesalers on a regular basis, but it's not just our industry. Any imported produce during the pandemic, all those containers that flowed smoothly around the world, moving product, all ended up in the wrong place essentially. And the overall view is that it could well take at least another year for that to settle down, because we've got to get through the spike in demand this Christmas, followed by the chaos that ensues for the Chinese New Year. And under normal circumstances, it takes 2 to 3 months after the Chinese New Year for things to settle down. So the overall view is that we have probably got at least another 12 months worth of high shipping costs. And then, commodity prices, just because of the demand that we saw. We talked about, right at the top end of this presentation, I talked about the surge in consumer demand. That surge in consumer demand is happening across the world, and that is putting huge pressure on the demand for commodities that are used in manufacturing processes. In our industry specifically, we're seeing it in plastics, any product with plastics in it. Some of the pulp products, etc., are all being impacted. So, it's definitely impacting and driving up inflation. At the moment, though, a lot of that hasn't yet been passed on to end consumer, and we are going to talk about that a little bit later. But consumer prices haven't yet started to really spike up. This one is a slightly different because it reverses itself out. But if you remember, just over 12 months ago, we had the Eat Out to Help Out scheme. Again, incredibly successful, but driven by a drop in prices as a result of VAT reductions on the hospitality sector, That reversed out, so we did see a spike in August. So when you're looking at year-on-year inflation measures, which that helped drive it up. And secondly, the overall VAT rate in the hospitality sector is now starting to return back to the standard 20% rate. We saw an increase at the end of September, and then the final increase back to the 20% standard rate is going to take place in March next year. But again, those changes will put further pressure on inflation. And the counter side of inflation is generally interest rates. So, depending on what type of economist you are, you will, different economists believe in, how you can use interest rates to control, manage inflation. And really, a high inflation environment is going to lead to an increase in interest rates. And we haven't yet seen any interest rate increases. The Bank of England are saying that they're not going to increase rates in the short term, but there is now, for the first time in the last probably 6 weeks or so, we're now starting to see a bit of talk about rates increasing. And we have seen the sort of the long-term government yields bounce up quite considerably. And overall, the expectation there is that means that that we are going to see interest rates rise over the longer term, driven by inflation.
Yeah, actually, I think they've just telegraphed.
Oh, have they today?
I think it was about 2 days ago or something.
Okay.
Yeah. So I think it's coming. Yeah.
Yeah.
Modest at the moment, they're saying, but yeah.
Yeah, I mean, and it's a key risk to inflation, interest rates. Business debts have increased significantly over the last 18 months, as has clearly government borrowing that I'll come on to in a second. So the cost of all that borrowing will spike. Exchange rates again tend to be the other side of interest rates. So they have remained very stable. We did see a strengthening of sterling at the start of this year, which I think was, as a result of, we got through the Brexit introduction of all the sort of the Brexit regime post beginning of January, and it was felt clearly by the markets who set these rates that the impact of it wasn't quite as bad as they were expecting. And so sterling did pick up by about 5%, and has remained relatively stable since then.
I think the only other point to make here is where we buy our products, because if you buy it in the Far East, then you've got the sterling to dollar or sterling to euro exchange rate is one thing, but then you've got that to the yuan. Is that right?
Yeah.
Which is less favourable, I think. But we'll keep going.
Okay, and so just to round up, this is the final slide. Government borrowing, which I guess is really the sort of the net effect of all of the above that we've just run through. As expected, Simon briefly talked about this sort of the investment that the government have put into the economy. Well, you can see it there on the right hand side. In 2020, we spiked at 300 billion of borrowing. I think overall the government spent around about 350 billion was pumped into the economy. But as a country, the borrowing did peak at around about 300 billion in that period. Now, again, in normal circumstances, you would expect that to take a lot longer to reduce, but actually the level of borrowing is coming down very, very quickly. Is forecast, it already is coming down as a result of that sharp recovery that we're seeing in GDP during the current year, and it is expected to almost get back down to, we'll be close to pre-pandemic levels within a couple of years, as long as some of those risks that I talked about earlier don't all kind of trigger at the same time. So I guess you know,
Nick, the cost of borrowing is in here. So if there is this unforeseen, even when this data was kind of panelled or collected, we didn't have inflation at the levels that we think it's going to be. So if they do need to put inflationary controls in place with interest rate, then would that not drive up the cost of borrowing and therefore bring this down at a slower rate?
Absolutely, and that is, you know, a key risk for the government at the moment, and the government have outsourced, you know, management of interest rates to the Bank of England now, and it is meant to be done at an arm's length. But the government as a whole is facing a problem there because the government has such, you know, huge levels of borrowing that small increases in interest rates. As just put in the text there on the left-hand side, a 1% rise in interest rates will result in a 12 billion increase in interest costs for the UK government. So you know, that has a massive impact, and yeah, would slow down the reduction. And you know, at the last budget, the government announced that, you know, we are going to start entering a higher tax regime. Corporation tax rates are going up, income tax thresholds are being held, national insurance rates are going up, etc. So, you know, which is very counter to a normal kind of Tory approach to managing the economy. But clearly, you know, we are in exceptional times. But yeah, we are entering that higher tax environment. So yeah, I think that's it overall.
Thank you, Nick, very much. So that's a macroeconomic view. It's just very difficult. I think we say uncertain, but it's very difficult to pin the tail on any donkey at the moment about what's gonna happen next. I think and as soon as any data is produced, it's kind of out of date because there are some real unforeseen kind of curveballs coming in. Don't think there was, you know, when this data was produced, oil pricing was a concern. The kind of Chinese winter and the Russian restrictions of gas was not quite foreseen. So gas supply is now, as we know, causing massive inflation. We know about freight in our sector already. We know about raw materials. We know about shortage of labour. In terms of lorry drivers, well publicised, but other labour as well. All of those do manifest themselves right into our industry because of the supply chain, and we're going to see cost price inflation, and without demand returning to where it is. So it's a very uncertain, unpredictable kind of short-term future environment, I think. And even some of the positive indicators bite us in the arse, sorry about the technical term, because the increase in household expenditure has led to a significant increase in demand. That increase in demand has led to increased pressure on a supply chain that is already very shaky. So very challenging, I think. We did have a whole session that in when we met in person on kind of the sociological changes, the way that we operate and behave as a society. We've left that out because that's a bit easier and more common for everyone to understand and kind of get their heads around themselves. But both the economic and the sociological changes have led to great technology changes, and this is quite well publicised. But we're going to talk about that a little bit now, and then try and hone it in specifically to our sector and say, well, how well is our sector set up with its current technology to kind of meet these changes? So Nick, thank you, brilliant as always. Take a glass of water and sit back and watch Rich. Rich, over to you. We're slightly behind the curve. The title, so as quick as you can be, please.
How long have I got?
You've got 5 minutes less than you originally had.
Excellent. Well, hi everyone. Nice to meet you all virtually. Simon mentioned earlier, I look after the technology for EO Group, and today I just want to discuss some of the key trends we believe are impacting our industry and how technology can help us with that. So I just want to go to the next slide, please.
Yeah.
Thanks. So just some of the key trends I wanted to discuss. Firstly, this rapid acceleration of e-commerce growth that we've seen through the pandemic. You know, the last 2 years it's been crazy, and across the globe it's been reported on how much people have moved to online channels. So we'll talk about how that affects customer experience and customer behavior. The disparity in our customer base now, this whole concept of hybrid working, and the fact that customers are everywhere. So, you know, and how can technology help us with that situation? Product diversification. We know that the sort of standard office supplies have seen a decline during this pandemic, but the world of specials and especially sort of facilities and packaging products have been really growing. So that diversity in product is key, and that range management is key, and technology can help with that. Supply chain disruption, we've all felt it in different ways, but the customer really wants visibility of what's going on and clear communication as to what's going on, and a lot of automation and technology now can help with that process. And then finally, cost price inflation, and how you can manage your margin better when we are facing, you know, changes in cost prices, you know, on weekly, monthly basis at the moment. But before we get into that, next slide, Simon, thank you. Just before we get into that, I just wanted to share some research that we found from McKinsey's, who did a sort of global B2B customer buying research piece, comparing pre-pandemic numbers to within the pandemic, and looking at the shift, this dramatic shift we've seen to customers going online and self-serving, rather than sort of being sold to through more traditional channels of phone and email or face-to-face sales. What the graph is showing you from the left to the right bars is 19 to 20 comparison, and the green is the sort of percentage of customers now wanting to self-serve, and that's through the whole product or purchasing cycle, really. So from the researching piece at the start, where customers are now spending a lot more time on Google and Bing and Amazon researching what they potentially might want to buy, through to the evaluation stages when they're looking at product reviews, they're looking at seller reviews, trying to understand, is it the right product to buy? What do other customers say about that product, and what do other customers say about the retailers or the resellers they're buying it from? Through to the actual order, you know, how easy is it to order a product? You know, is the checkout process easy to navigate through? Are all the payment options there that I need? And is the communication good around the order? Do I get strong confirmation that the order's been placed? You know, dispatch notifications, tracking on my delivery to understand when it's actually going to turn up. And then finally, that reordering process and the sort of, you know, the dynamic my account sections that you see on websites nowadays, where people can view past orders, they can look at invoices, they can reorder products they've done before and see the last price they paid for it quickly. You know, all of that is growing, and that is really increasing throughout this pandemic. So based on that, the good news though is that this it sounds a bit doom and gloom, but it's actually good news for us. What we've done is we've looked at the last couple of years of data across our businesses, and what we can see is when customers are ordering themselves online, it does actually have quite a strong commercial impact on us. So the left-hand graph is showing average order size, the right-hand one is showing margin, and the green line is the customer placing the order, the yellow is the dealer or the service team is potentially placing the order. And what we can see is you get a 17% increase in average order size when the customer is placing the order themselves online, and a 12% on average higher gross margin, and that's driven by numerous things. You know, it's less negotiation at basket, you know, the customer sort of accepting the price and not wanting to negotiate on every order over the phone. Sort of less tendency to offer a last price paid approach, especially if, you know, cost prices are fluctuating, and probably less general conversations about price, and more customers sort of liking the service they see from what they read online, liking the reviews they see from other customers, and that's enough to get them to order. And so it is good for us. You can see some positive commercial sort of performance from this change that we're seeing in self-service.
It's also worth pointing out the actual cost of the transaction, depending on your total cost of ownership of your technology, should be lower if the customer is ordering online, just by the nature of automation. So that drive can be beneficial.
Yeah, thank you. So just to start exploring some of those trends I mentioned at the start. Firstly, this acceleration in e-commerce growth. Now, what's been key for us and what we've looked at quite heavily through this is ensuring that you have an accurate and single view of these customers that are now operating in a much more of a multi-channel environment. Now, in our industry, there's lots of different systems. You know, you have your Horizons, your Primas, your Oasis, and then potentially those systems are partnering with CRM systems like SalesEye or Pipedrive, and then potentially front-end systems like Evolution. And they're all good systems, but they're all separate systems, and they're all separate databases. And then so trying to actually sort of configure and integrate that very complex integration path into a single view of what the customer's doing is very challenging, but it's really, really key that technology can support that. You know, if you're capturing data through CRM on, you know, customer firmographics or the shopping behaviors and consumption patterns of customers, you really want that accurate data to be reflected in your front end website as well, and potentially your back end for your sales teams, and in real time, so there's no latency on the data. You know, there's ways of reconciling the data that is accurate, and that you can use that data in sort of promotional campaigns or marketing campaigns, so, and really sort of drive the customer's experience online. So that's been absolutely key. Next slide, please. Thank you. Then this the fact customers have gone everywhere, you know, this hybrid working environment that we now live in. You know, we're all expecting, I think, in September and October to see a rush of people going back to offices, but that's not, you know, it's not been as quick as we expected. A lot of people working from home still, but it's absolutely key that we can identify these customers. You know, no longer are they potentially working on the same computer because they're not actually in the office. Maybe they're on a different device, and how do we know it's the same customer? So capturing data live on when the customer is on that website, and being able to store that data against the customer record to ask them questions like, well, where are you working from? Are you working from home? Are you working in the office? You know, what is your role now in the business? What's happened to your business? You know, you know, are you on furlough? Understanding those things about our customer base is key. Asking those questions by capturing that data through the front end. You know, technology is there to do that now, and then use that data to actually change the customer behavior and customer experience, so that they see different promotions, different products, you know, different banners on the website that are relevant to the data that they've provided us in the system. And
the difference is that if we're seeing huge rise in automation or customers doing themselves, then the ability for the sales experience to be personalized, whereas previously it would be in the salesperson's head, they would know this customer for a very long time, or the owner of the customer. Now it becomes a lot more difficult, so data becomes increasingly important in that personalized experience. If you want to change behavior, which we have to do because their behavior has changed, so therefore we need to match it. So I think the key point here is that technology needs to support that knowledge of the customer in a greater way than it was previously, I think.
Yeah, thank you. Sorry, just the last point on that is it's also giving the customers controls as well. Now, with large customers whose staff have now all gone to work from home, you know, they need to be able to control spend still. They don't want large expense accounts. They don't want all their staff shopping on Amazon and expensing everything back. So having the cost center structures, approval workflows in ordering, all those B2B, you know, they're not B2C tools, they're really B2B ordering tools. It is imperative in the technology now to give those sort of master customers the controls that they need around their staff spend. Then, you know, if you take the fact that everyone's now wanting to self-serve more, if the fact that everyone's working everywhere, it's key that we have a targeted contact strategy, and that's across all channels, whether that's the website or through the sales teams that you might have. And you want a system again that can organize that for you. Now, if you've got a system that can also use that data, as Simon's mentioning, to actually look at behavior, look at opportunities to grow your business, you can start to build segmentation models and hive off segments of customers and offer them specific promotions or specific marketing campaigns to drive their behavior and change their behavior. Now that might be upselling and cross-selling, or it might just be trying to push your margin or the key products up that you might want to sell within your business. And giving you that visibility of gap analysis and the opportunities that sit within your business is key, not only to use on the front end system for the website, but also for the back end system, so that your direct sales and your sales teams have the same sort of consistent information and can try and drive those profitable sales. And that consistency through channels, you know, whether it's email, whether it's the website, or whether it's the salesperson, you want that consistency across the board. And again, that is absolutely key. On the diversity of products, as mentioned earlier, we have seen a huge reduction in consumption of traditional office supplies and a definite move to an increase in other categories and more special type products. But again, you need your technology to help you with this. You need technology that can manage multiple catalogs, not just the standard office supplies catalogs that you may have in your systems, that can take those diverse product ranges, can merchandise them, can have them on the website for your customers to buy from. It can map hierarchy groups and search and attribution functionality so that customers can find these products easily, and that you can cross-sell these products easily to people that potentially are not aware of the fact that you sell them. And with the fact of cost prices changing, with the fact that challenges in the supply chain and stock being an issue, you want the ability to multi-source. You want the fact that a product might come from 3 or 4 different suppliers. And if you are having issues with getting stock from one supplier, your system can automatically and dynamically switch to a different supplier, so your customer can always see those products in stock and available to buy. And then finally, as I said, you know, this increase in specials, this increase in not the sort of standard mix, is key as well. You need the ability for your technology to just build products, integrate new suppliers, as many as you want. I think on our system we have close to 600 suppliers now in the system, where dealers just want to be able to plug in different suppliers, range different products, and sell whatever they need to sell to their customer base. And again, that is key from your technology. Just on the supply chain, as I said, we've all felt some disruption in the supply chain during this pandemic, and customers probably the most affected. But for customers, it's really important, again, from a technology point of view, to give them visibility of what's going on. So that might be clear communication through email channels or sales channels on what's going on with their order. A website that has a clear, my account section where you can track orders, you can see exactly what's going on with couriers. If there are delays in your delivery, that it's telling you that. It's informing you of what's going on. If if there are stock issues and back orders are in place, the communication is there on that as well, and giving you the options to potentially switch products. Or from if you're a business that has its own stock, accurate stock management, forecasting models which will enable you to look at how stock is going to change and ensure that you keep those ranges on your website. And then finally, customers, especially when they're working from home and not in the office, they don't really want to use their own home phone or their mobile to phone up a customer service department and arrange a return or a query on a delivery. They just want to be able to go online, simply raise a query in a system, and get a nice quick response back from that reseller or that business. And it's key again that your technology enables your customer to do that from a self-service point of view. And then finally, just on managing margin, obviously cost price fluctuation has hit us all, but it's imperative that you can control that and you can have visibility of it. Dynamic pricing tools are now sort of seen as a key piece of technology to have, where you can protect your target margins on products or categories or departments. And if cost price fluctuation does happen, you have the ability to dynamically and automatically move sale pricing and pass on some of that cost to your customer base. And you don't want to be downloading spreadsheets and uploading spreadsheets and manually manipulating all of this. You want a system that can automate all of this for you, and on a live basis can control your margin. And that's across all different pricing types, including, contracts are a key pricing tool that I think we use in this industry. We want the ability to have either fixed contracts where we protect that price for the customer, or dynamic contracts where we can pass some of those increases on and have a sensible discussion with the customer. And forecast, if cost pricing is increasing, and if we can't swallow the cost ourselves, be able to forecast what that's going to do to your overall business in the next 12 months and make some really sound decisions on how you move your pricing model going forward.
Great, thanks, Rich. So I'm just we're behind time actually, so I'm going to rush through this next bit. But the lens that we're looking through here is the technology that exists in our sector, is it set up to support the shifts that we're seeing both in behaviour, but also in the dynamics that are going to flow through because of the economic changes. Now, this is a slide that shows a full tech stack this is a stack that wasn't actually implemented. The business was a very large European distributor that ran out of money, not only on this implementation, but actually, unfortunately, ran out of money and disappeared, not UK based. So what you can see is they went to market and bought for each functional module. This is basically the best that money can buy. And was trying to integrate them. This was about, I think, an 11 million initial build, and then about 4 million a year operating ownership. The problem that we've got in our sector is that we do have stacks, and the problem with stacks is they need to be kept up to date. They're quite expensive to maintain, and historically in our sector they're underinvested. What we think is the ideal, now we kind of would say this because this is what we built, but you want a single, you basically want, unless you're a very large business, you want a single kind of plug and play back-end and e-commerce system that just sits on top of your accounting layer, your ERP, but that doesn't really exist, and that's the challenge, and the total cost of ownership of that is challenging because the build costs are quite expensive. So I'm kind of out of time. I think to conclude, we've got from our kind of desk research, if you want, and thank you, Nick and Rich, very much. We've got some very uncertain challenges coming our way, both economic and sociological. Our behaviours are very much changing, and we're not actually sure, which is will be our last session today. We're not actually sure what's going to happen. So how do we plan into that?